Hello and welcome to another online module. So by now you already know how to operate the framework that allows us to predict the movements in the exchange rates. And an important factor in that framework is the interest rates or expectations about the interest rates in the countries involved. But in this lecture, I want to dig a little bit deeper and refresh with you what you already know, I think, about what interest rates depend on. So this material is covered in Principles of Macro, and I understand it if it's been a long time since you took that. It is also refreshed in Money and Banking course and maybe a few other courses. In any case, I would like to start with saying that we can think of the interest rate as the price of money. Basically, how much do we have to pay in order to get access to, let's say, a loan? And just like any price is determined by events affecting supply and demand in the market for that product, the interest rate is also determined by events in the money market. In our analysis, we will be mainly concerned with two factors, and those are the two most important groups of factors. The monetary policy conducted by the Central Monetary Authority and the level of economic activity. Well, real economic growth or maybe a recession, something like that. Well, since prices in every market are determined by forces of supply and demand, let's talk about money supply and money demand. First, money supply. Money supply is the total amount of money held by households and firms at any given moment in time. I hope you've been exposed to enough business classes to know by now that money is not just currency and coins. We deal every day with electronic money that no one can see. We write checks and so on and so forth. So the definition of money includes much more than currency and coins. In fact, there are several definitions of money, as crazy as it sounds, and they're just different in what kind of forms they include. So the most narrow definition of money, M0, is currency and coins. If we add to that checkable deposits and traveler's checks, which are fairly easy to convert into purchases, we already have a broader definition, M1. Then we can keep modifying it, adding less and less liquid forms of money. Remember, liquidity is the ease with which a specific asset can be turned into purchases. I'm not going to dwell too much on these definitions. They're of secondary importance to us. I just thought I'd mention them here, but I don't think you should worry about them too much, not for this class anyway. Let's save that for the money and banking class. As you know, all the supply and demand curves are usually plotted with price on the vertical and quantity on horizontal. So adapting the same framework to the money market, that means the quantity of money will be on the horizontal axis and the price of money or the interest rate is on the vertical axis. So in this framework, money supply looks very peculiar because money supplied is determined by the monetary policy, by the actions of the central bank, Central Monetary Authority in a country, which for the case of the United States will be Federal Reserve System. But money supply is just a number that does not depend on the interest rate. Therefore, the money supply is just a vertical line because the quantity of money available for purchases is a number that doesn't depend on the interest rate. Next, let's talk about the tools of monetary policy, in other words, actions by the Central Monetary Authority that can affect the money supply. Before we do that, I'd like to say a few words about the banking system in general. In the majority of economies, the banking system is set up as what is known as the fractional reserve banking, which basically means that a bank is allowed to loan or to lend some of the deposits that are brought and deposited into the bank, but it cannot loan all of them. A certain fraction of the deposits needs to be put in reserves. So for the example that is about to appear on this slide, let's assume in this country we have a 10% reserve requirement. Then when John deposits his paycheck into Bank 1, then the bank can lend a portion of that money to somebody else, like Jane. However, this does not mean that the bank can lend full $500. 10% reserve requirement implies that 10% of this sum, or $50, needs to be put in reserves. And those reserves are usually kept with the central bank. So the commercial banks, the private banks, don't have access to that money. So $50 gets put into the reserves, and then $450 remaining can be loaned to Jane. Jane goes shopping and buys a wonderful designer bag. So the vendor that sold that bag to her deposits the money into the bank with which they are banking. $450 that Jane paid gets deposited in a bank. That bank then takes $45, 10% of this sum, puts it in reserves, and then the remaining $405 once again can be loaned. So let's say they loan it to Jared, and Jared goes and blows this entire amount on Subway sandwiches. So Subway restaurant deposits the money they collected from Jared into Bank 3, and so it goes. As you can see, one initial transaction, one initial bank deposit creates a stream of transactions, but this stream will gradually dry out. And in fact, knowing the reserve requirement allows us to predict how much money will be created in this economy under this fractional reserve system. When John gets paid $500, the money supply increases by more than $500. See that? $500 to John, and then $450 to Jane, and then $405 to Jared, and then so on, so on, so on. There are formulas for money multipliers that allow us to calculate the total amount of money supply, but once again, that is beyond the scope of our class. We're discussing the tools of monetary policy only to make the connection. So, how's your critical thinking today? Let's try to do this together. Let's try to discuss what happens if the central bank in a country raises the reserve ratio requirement. And not so long ago, the Bank of China did something like that. And in the past, the Federal Reserve in this country also made some changes to the reserve ratio. So, okay, if the reserve ratio requirement is raised, remember, we're doing this together, no cheating. You have to think of an answer before I say what the answer is. When the reserve ratio requirement is raised, is it more money or less money that is put in reserves? More money. Correct. I hope we agree. Then what happens to the amount of money that is available for lending? It will be less. So, as a result, the overall amount of money that can be used for loans is smaller. It decreases. Now, if anything becomes in a shorter supply, becomes less available, what happens to its price? Usually, the more scarce the good is, the higher is the price, the more valuable it is. If we apply the same principle to the money market, that tells us that the interest rate, which is the price of money, will increase. Less money in the economy, same competition for loans, the interest rate has to increase. And when interest rates increase, and that's where sometimes we disagree, but I hope I will be able to pull you on my side. When interest rates in the economy are higher, as a result of that, is it good for the economic growth or not so good for economic growth? Well, the economic growth is driven by firms that start businesses, produce new products, hire workers, pay workers. Workers go and spend that money on sandwiches and designer bags, and so on and so forth, right? So the firm's ability to start businesses depends on the interest rate. If interest rates are high, fewer firms will want to take a loan. When interest rates are low, then other things being equal, it's easier to start a business. There is less financial risk. Therefore, more firms will do that. Okay, back to where we are. If interest rates are higher, as they are in our example, the economy slows down because fewer projects are started, fewer companies are started, and so on and so forth. Fewer workers are hired, less money is paid in payroll. Is everyone okay with this? All right, well, of course, the second scenario is the opposite. When the reserve ratio requirement is lowered, then more money stays in the circulation, so the money supply increases, money is more available, banks want to lend that money out, and they compete with each other for the right to lend it. So the interest rate, as a result, decreases, which is good for the economy. It stimulates the economy. I hope you see the logic, I hope you can follow the reasoning, and I hope that you agree with that reasoning. The next monetary tool is called the discount rate. So this is different from the rate of discounting future earnings or whatnot across time. And it always beats me why textbook writers in economics and finance have to use the same term for two entirely different things. So I apologize on behalf of the entire kin of economists. But this particular discount rate is the rate at which banks may borrow money from the Federal Reserve or from the central bank. In principle, where do banks get money that they can later loan? Mainly it's from deposits, of course. But, sometimes there are shortfalls, some cash problems, and mainly banks borrow from each other. We will talk about that on the next slide. But suppose all the banks, just so happen that all the banks suddenly run out of money. Where do you go? Well, you go to your parent, the Federal Reserve, and ask them for money. So the Federal Reserve will lend you money, assuming you're a sound financial institution, and there is a set rate, and that rate is officially published. And there are several tiers of that. The most common is so-called primary credit rate. It is currently 1%, I believe. So this is it. That's the discount rate. So when the discount rate is raised, then it is harder for banks to get money from the Fed, correct? So the cost of getting that money increases. So whenever the cost of getting something or doing something increases, that's a decrease in supply. So the same principle applies here. If it's costlier for banks to get money that they can later lend, then the supply of money will decrease. Banks will be more reluctant to do that. And as a result, decrease in supply of money is reflected in the interest rates in the economy. So interest rates for all other loans, consumer loans, auto loans, mortgages, and so on and so forth. All the interest rates go up. So when interest rates are higher, we discussed that on the previous slide, not good for economic activity. Economic activity slows down. So really, this is it. So what about that other rate? The rate at which banks borrow from each other. And as I said on the previous slide, most of the borrowing is going on between the banks. Kind of counterintuitively again, the name for that rate at which banks lend and borrow to and from each other is federal funds rate. You would think that, federal funds is what's coming from the Federal Reserve, but nope. So federal funds rate, as this definition goes, large financial institutions swap money back and forth. Whoever needs money more tonight because tomorrow a big depositor is coming to get the money. For those reasons, banks may lend money to each other short term. So this is the most important rate that is usually announced after Federal Reserve Policy Committee meetings. When you hear in the news that the Federal Reserve or the Fed has raised the rates or left the rates unchanged, this is the rate that we are most frequently talking about. Because this is the rate that changed most often, even though it wasn't changed for several years here in this country. But in principle, it is changed more often than the reserve ratio requirement or the discount rate, the previous two instruments. So it is important to understand that this rate is determined by market forces. Well, how big is the shortage of money that banks need? And that is kind of counterintuitive, right? If it's market forces, then how can the Fed determine or announce what this rate is going to be? It's unpredictable. It's just like, imagine like a central meteorological committee comes out on TV and says, well, from now on, the temperature in Kansas will be 68 degrees, right? We can't rule that. But this money market is different because, yes, there is a money supplied and money demanded. But you have to keep in mind that the Federal Reserve System is a fairly large player. It has huge coffers. And if it wants, it can take some actions in the money market that would preserve the rate within the limits that the Federal Reserve Policy Committee has committed to. And one thing I forgot to mention is that currently the federal funds rate is in the range of 0.25 to 0.5%. So there is some discretion within this window. There is some flexibility that the Federal Reserve has. But it has committed to the fact that the rate will not be outside of those limits. So what exactly are those mysterious actions that the Federal Reserve undertakes? So this is the third monetary instrument used by the central banks. Central banks can control the amount of money in circulation, or in other words, the money supply. And by doing this, they affect the interest rates, including the target interest rate that we talked about on the previous slide, by buying and selling some financial assets. And usually the most common way to do this is to trade treasury bills, which essentially are the government bonds, short-term government bonds. This monetary tool is often referred to as open market operations, but the term open market operations can mean anything, right? So you really need to know what that is. So just to rewind a little bit, the Federal Reserve or any central bank, they have assets on their balance sheet. So basically anything of value. In the case of Federal Reserve, some of those assets in reserves are in dollar bills, some are in maybe foreign currency, some are in precious metals, and some are in treasury bills, government securities. So what's important to understand, there is a difference between generally defined asset and money. Money is also an asset, but not every asset is money. Treasury bill is not money because you cannot go shopping holding a treasury bill in your hand. So that's an important thing to understand. If you understand that, then the next slide will be very straightforward for you. So when the Federal Reserve or the central bank sells government securities, what happens? The government securities or the treasury bills get transferred from the Federal Reserve Bank onto the open market to constituents who feel like buying a treasury bill at the right price. Those constituents, private banks, investment companies, maybe even private investors, they get treasury bills. What does the Fed get? Well, the Fed gets money. It collects the money from that market and takes it and locks it up. That money gets withdrawn from the circulation. no one can any longer do anything with that money. So if you understand that, then the rest is very straightforward. Of course, money supply decreases, and whenever money supply decreases, the equilibrium interest rate increases. Remember, we talked about this as a tool that the Federal Reserve can use to ensure that the target market interest rate stays at where the Federal Reserve promised it will be. Okay, now when the opposite happens, when the Federal Reserve goes into the market and buys treasury bills, it has to unlock its vaults and get dollars out of them and give it to those private banks and investment companies that sell treasury bills on that day. So some money gets added to the circulation. And then after that, the banks can lend that money and the process starts again. So money gets injected in the economy and money supply increases as a result. And as a result, the equilibrium interest rate gets lower. And that's it, as simple as that. So these three monetary tools are the main monetary tools that we most often deal with. Sometimes, at special times, the central banks may experiment with some other ways to affect money supply. For example, after the last financial crisis, the Federal Reserve did what became known as the quantitative easing. So the name suggests that the Federal Reserve releases some money into the economy. And that's exactly what it was. Except on this occasion, the Fed wasn't buying treasury bills. It was buying those mortgage securities, unbacked, toxic mortgage securities that laid frozen in banks' vaults and were overinflating their balance sheets and basically making the entire banking system collapse. But as I just said, if you know these three main monetary tools, then you know enough for us to carry on. So we're done with supply of money and factors that affect supply. Only Federal Reserve or central bank can affect supply of money. Well, let's talk about demand for money. Demand for money is entirely up to all those private parties that populate the market. We need money for transactions, to start projects, to make transactions. Therefore, it should be obvious that the amount of money that private parties in the economy are willing to have in their hands depends on the amount of transactions they want to make. So it depends on the amount of goods produced in the economy. So that's a third bullet. Well, the more expensive those items are, the more units of currency you want to hold. So that's the second bullet. And then, of course, if you need to turn to banks to get your money, to have the ability to spend money, your appetite for money also depends on the interest rate. If your credit card company charges you an arm and a leg, well, you would say, you know what, no thank you. So these are the three most important factors that affect the demand or the appetite for money that comes from firms, businesses, individuals operating in the economy. I find this next equation quite helpful in understanding demand for money. Even though it's overly simplistic, no question about that, nevertheless, it captures the important intuition behind how money is exchanged for goods and vice versa. So in this equation, M stands for the stock of money in circulation, and doesn't matter how we define it. Let's say it's M2. That's the most common use of the definition of the supply of money. V is the velocity of money. That's a new term to you. You can think of it as an answer to a simple question. How many times does each unit of currency change hands in a year? No one is trying to follow a dollar bill and count the times. But nevertheless, it's a concept that really helps us see the big picture. So let's just introduce it and move on. Well, then the right-hand side consists of the price level and the total number of goods and services produced in a year. Why is there an equality? Well, if you think about this equation, the right-hand side is the dollar value of all products made in the economy, right? GDP, products made. Price is kind of price index. So what does everything cost? So the right-hand side is the GDP in dollar terms. The letter Y is just the physical units of the good, but when you multiply it by the price level, you get the GDP in the dollar terms. But in the market economy, how do we know what the goods are worth? We know that when we sell them. So in order for us to sell the goods, someone on the left-hand side of this equation has to buy them. And what is the purchasing power that buyers in the economy have? Well, that's the amount of units of currency in circulation, or money supply, times how fast does the money change hands. So this velocity of money. And so the left-hand side, the entire left-hand side, therefore represents purchasing power. And the only thing that this equation says is that the amount of money that someone pays in the process of making transactions equals the amount of money that someone else receives on the other side of this transaction. That's all. Note how the Fisher equation actually incorporates the amount of goods and services and the price level that we talk about in the top portion of this slide. And we're about to discuss how it also incorporates the interest rate. So in principle, we would like to express the relationship between the quantity of money demanded and variables such as interest rate, price level, and the volume of output in the country. Those are the three variables, three factors listed on the previous slide. But how do we put all these variables on one two-dimensional graph? That's too many variables. So we need to find a way to simplify things a bit. First of all, for our purposes, it is more convenient to operate the notion of the real money, or in other words, the purchasing power that we hold. How many dollars we have is only meaningful in conjunction with what the price level is, right? So if we divide the total amount of money in nominal units by the price level or price index, then that tells us, gives us an idea of our purchasing power. So on the horizontal axis, we will use not just M, amount of money, but the amount of purchasing power. That's the convention in this kind of graphs. Okay, so if we play with the Fisher equation a little bit, we can rearrange it in the following way. Okay, so where is the interest rate here? If you think about it, if the interest rate is high, then people don't like to hold money because the opportunity cost of holding money is too high. Because if banks give you high interest rates, then you want to get your paycheck and run and put the money in the bank, in the deposit account as quickly as possible, because it should start earning the interest. Or conversely, if you take out a loan to buy something, you don't take out a loan and hold on to that money for months if the interest rate is high. The higher the interest rate, the faster you want to put your money back into circulation. So in that sense, the higher the interest rate, the higher is velocity of money. And when velocity of money is high, the denominator in the right-hand side is large, then the left-hand side will be smaller. So I hope when you read this last sentence on this slide, it agrees with you. To summarize what we just came up with on the previous slide, so the amount of money individuals and firms in the economy desire to hold depends on the interest rate. And the higher the interest rate, the less do people want to hold that money. So there is a negative relationship between the interest rate and M. The higher the price level, the more nominal units of money you need. So there is a positive relationship. And the more goods and services are out there for you to buy, the more money you need. So there is a positive relationship here as well. So finally, we decide to plot it. And remember the issue that we have only 2 dimensions, 2 axes, but 4 variables. So we kind of took care of the price variable by putting it together with M. So now it's a purchasing power on the horizontal axis. The interest rate is an important variable, so we put it on the vertical axis. But then there is still this issue of the amount of goods and services. Well, unfortunately, there is no room for it. So in order to express the effect of that variable on the demand for money, we will have to shift the demand curve, like we often do in regular demand graphs. If anything is not on any of the axes, we have to draw a new demand curve. And we will do precisely that when the aggregate production or aggregate output will change. If more output is produced in the economy, so buyers desire to buy more items, then that increases the demand for money and the demand curve shifts to the right, as shown on this graph. If there is a stagnation or recession in the economy and firms are not pumping the output as they would normally do, then, we don't need money because, there is less things to buy, and actually we're not that concerned with buying because we're not sure what the future brings to us. And as a result, demand for money decreases and the demand curve would shift to the left. So if we combine all our hard work in this lecture on one graph, put the supply of money and demand for money in this set of axes, the purchasing power or real money or M over P on the horizontal axis and the interest rate on the vertical axis, that's what we will see. And as is true for any supply and demand graph, really the point that we are interested in is the intersection point, the equilibrium. Because if quantity demanded of money exceeds quantity supplied, then the interest rates will adjust. Or if the quantity supplied of money is higher than the quantity demanded of money, then once again the interest rates will go towards that equilibrium. Therefore, we are most concerned with the location of this equilibrium point, which will determine the market interest rate in this country. So just to close the loop, this is what we will do next. Now that we are able to discuss the factors that determine the interest rates in the economy, we can combine that graph, the money market graph, with the graph for the exchange rate market and analyze the two together. That's what we will do in the next lecture. So I'll see you in the next class.